Hello everyone, this is the first of two videos on financial ratio analysis. In this video we're going to talk a little bit about what financial ratio analysis is, and then we're going to go through a number of the different ratios that are important for looking at when analyzing a firm. So just to start off with, we get our financial ratios from the financial statements of the firm. Specifically, we look at the income statement, we look at the balance sheet, we look at the statement of cash flows. The income statement and the statement of cash flows measure the flow of income or cash flows for a business over time. So for example, if we're looking at the income statement for 2022 for Walmart, which we will here in a minute, we're seeing the revenues generated during that year for Walmart. Okay, we're looking at the expenses that have been incurred during that year for Walmart. If we're looking at the balance sheet, we're actually looking at a snapshot in time of the values of certain accounts. So, for example, and I'll just pull it up here, for Walmart, we see that in 2022, they had, and these are in millions of dollars, they had revenues of $572.754 million during that year, or $572.7 billion worth of revenues during that year. And so that represents the revenues over a period of time. Ratios are analyzed in two different dimensions, one across time for the same firm, and we refer to this as trend analysis. And across firms or compared to the industry for the same point in time. And this is referred to as benchmark analysis. It's important to note that the value of a ratio by itself, in most cases, doesn't tell us a whole lot. If I told you the current ratio for a company was 2 or 2 times, that wouldn't mean a whole lot unless I saw the trend over time for that ratio for the same firm. So, it might be a situation where a higher current ratio is better. And so if that current ratio had been increasing over time to 2, that would be a good positive trend. On the other hand, it could be that current ratio has been decreasing over time to 2. And so that 2 may not actually represent a very good number for that firm in that instance. It can also be a situation where we want to compare it to the industry itself, where the rest of the industry is. And so 2 could be a very high current ratio within an industry, or could be a very low current ratio within that industry. So the number itself, in most cases, does not provide much information for us. We want to either look at the trend or the benchmark, and in most cases we actually want to look at both. A growth rate captures the year-on-year percentage change in a line item. So when we talk about growth rates, for example, if we said revenues were growing at 5% a year, that would be the increase percentage from one year to the next. Growth rates for dollar amount of line items can be divided into two different parts: the growth rate due to growth in operations, or the number of units being sold, or growth rate due to inflation. So let's look at Walmart. So we see Walmart, we'll just look at their revenue from January 31st of 2021 to January 31st of 2022. So the dollar amount that they sold during this period of time increased from the previous years. Okay, so that increase is going to come from two different places. One, more units being sold, okay, and two, the increased price that they're selling those units at. And so we want to recognize that whenever we're looking at a company, that you can have a company whose sales numbers, the dollar amount is growing, but they could actually be decreasing the number of units being sold because they're charging a higher and higher price, which could be due to inflation. We saw that certainly in the past few years with high inflation rates, where a lot of this increase from January, especially January 31st, 2022 to January 31st, 2023, likely came from an increase in prices due to inflation. We had about an 8% inflation rate in 2022. And so it's important to keep in mind how and what's causing an increase in these numbers. So now we're going to talk about some of the different ratios that we look at when we analyze a company. The first is profitability ratios. In general, what the profitability ratios tell us is oftentimes not what people think they tell us. What profitability ratios really tell us are how well managers control expenses relative to the revenues being generated. Let me just put that in here. These tell us how well managers are controlling expenses relative to the revenues being generated. So you'll hear the term margin a lot when we talk about profitability ratios. And so we're going to talk about the three main ratios that are based on a margin in this first part. So margins capture the amount of a line item scaled by revenues. And that's the key thing here. So whenever you hear gross profit margin, operating profit margin, net profit margin, those are all those numbers, the gross profit, the operating profit, and the net profit divided by the revenues or the sales of the company for the year. So what we see here is that the gross profit margin is equal to gross profit divided by total revenues or total sales, depending on the financial statement you're looking at. So this margin tells us how well managers control the cost of goods sold relative to the revenues being generated. For a lot of companies, especially retailers, that cost of goods sold line is the number one expense that they're going to have. And so controlling that expense is very important. And just as a reminder, cost of goods sold is what the company is paying for the goods that they're selling. So for example, we're looking at Walmart. If you go into Walmart and you buy a loaf of bread, the cost of goods sold for them is what they paid for that loaf of bread that you just bought. So it tends to be a very important number, especially for retailers. And what we want to usually see is that this gross profit margin is increasing over time. In other words, they're controlling or they're reducing the cost of goods sold for every dollar of unit they're selling. So usually increasing and higher is better. And you'll hear me say that a lot usually because there's cases in which that's not a good thing. They might be extreme or rare cases, but they do exist where, increasing this number could harm the competitiveness of the firm. It could, be beneficial in the short term, but in the long term. But in general, for companies, this number is what we want to see increase or at least stay stable over time. The operating profit margin is equal to EBIT divided by total revenues. And like, the previous one, what this is telling us is how well managers control operating cost relative to the revenues being generated. So operating cost would include, let me make that plural, would include the cost of goods sold, which is in that gross profit margin. It's also going to include wages for employees. It's also going to include things like insurance, and those items as well. So every cost associated with operating the company is going to be included in this. Just as a reminder, EBIT stands for earnings before interest and taxes. So we count that as, or we consider that to be the operating costs of the firm, because interest is not generally an operating cost for a firm. It is the result of a financing decision. So, interest expense comes from having to pay interest on things like bonds or things like loans that the company has taken out. Or interest income, for most companies, is not part of their operations because they're not in the business of investing money in financial securities or in things like loans that they make to other people, unless it's a bank or some other type of investment company. And so those things are not counted as operating costs or operating income. They're considered a part of the financing company portion of the firm. And so it's not included in the operations of the company. Finally, the net profit margin, aka the net income margin, because we might see that last item on the income statement being either net profit or net income. And this tells us how well managers control all of the expenses of the firm relative to the revenues that they're bringing in. And so those expenses would include all of the operating expenses, the cost of goods sold, the interest expense, the taxes that are being paid out, everything, taking us to the bottom of that income statement for our net profit or our net income number. So I'll just pull up the income statement here for Walmart just to show you this. So if we look here on Walmart's income statement, we see we start up here with revenues, total revenues for the firm. We take out the cost of goods sold. We take out the operating cost. Here they have them kind of lined out. Selling, general, and administrative expense. That's also referred to sometimes as SG&A expense. R&D and research and development expense. They don't show any reported here. It doesn't mean that Walmart doesn't have that expense. It's that it's not a single line item for them. Depreciation and amortization expense. Walmart does have this. And with Capital IQ, this is often included. You'll see this on the statement of cash flows if you want to find it. And other operating expenses income is also a separate line item here in Capital IQ, but not showing any for Walmart for these years. So they bundled everything up here in their SG&A expense. And what we're looking at when we look at these margins is how well is management controlling these costs based on the amount of revenues that they're generating. When you think of a lot of companies, especially ones like Walmart, the amount of revenues that they're generating, the amount of sales are generating are limited. The ability to increase those numbers are somewhat limited. So if you think of Walmart, and especially if you live here in the United States, Walmart's everywhere. Walmart essentially has a store anywhere that it would make sense for them to have a store. And so it's difficult for them to actually increase their revenues one year to the next because they can't just go out and build another store. They are restricted by kind of the growth in the population where those stores already exist. And so their ability to increase revenues is significantly limited based on that. Although they've successfully been increasing their revenues year to year, they're not large increases, okay, percentage-wise from one year to the next. And so really at this point in the life cycle of a company like Walmart, really the goal of management is oftentimes to shrink the expenses relative to the amount of revenues that they can generate. So some important definitions, and I've mentioned this a little bit so far. Operating profit. We generally define operating profit as earnings before interest and taxes. Also known as EBIT. Operating cash flows. Operating cash flows are generally defined as what's called EBITDA. Or earnings before interest, taxes. I apologize, there's a mistake up here. There we go. Depreciation and amortization. Depreciation and amortization are added back because they're non-cash expenses. So when you see depreciation expense or you see amortization expense on an income statement, these are expenses that they are recognizing, but they're not actually expenses that they're paying cash out for. So, if you see cost of goods sold, at some point in time, that company is going to pay cash for that inventory that they bought. Okay, and that's what cost of goods sold is, in part. But when you see depreciation expense, they're not actually making a check out to depreciation. They're recognizing the loss in value of a fixed asset over time. And that's what depreciation is. So it's added back when we calculate the operating cash flows because it's a non-cash expense. Amortization is similar. Amortization is oftentimes recognizing the expense of a intangible item over time after it's been acquired by a firm. Total capital. So this is an interesting one. There are many definitions of what capital is. Some people define capital as the value of assets. You'll see that sometimes it is the value of all of the claims on the firm. I'm going to go with, and for our purposes, what capital is the dollars that have been invested by investors into the firm. So capital is going to include So capital is going to include the amount that has been paid in terms of equity by investors, by stockholders. So whenever a company has their IPO and they issue their stock for the first time, that's when money is taken from investors, from stockholders, and given to the company to fund their operations or to fund their investment, or actually in many cases just to pay off the original investors of the firm. So you have that money going in, and then any earnings that have been retained by the firm over time. So whenever a company like Walmart makes money, they have a choice of what they're going to do with that money. They can either pay it out to the stockholders of the company, or they can retain it for further investment, for further growth. When they do that, when they retain earnings, that means that they're keeping money that could be paid out to the stockholders, and they're keeping it for reinvestment. And so we would want to include that as an investor supplied fund. So the investor supplied funds, the capital include the value of the equity on the balance sheet, the value of retained earnings, the value of any interest-bearing liabilities. So if the company has issued bonds, if the company has issued loans through banks, so a bank gives them a loan, that would also be an investor supplied funds. That bank is essentially investing in in Walmart to generate income, interest income. So that's what we would include in our total capital. So this includes the value of common equity, retained earnings, and interest-bearing liabilities. Bonds, long-term debts, and notes. Well, we'll just say etc. It does not include non-interest-bearing liabilities, things like accounts payable or accrued expenses, because those aren't funds provided by investors. The key here is that we're looking at the money that is put in or retained in that belongs to the investors. So let's look at Walmart really quick here. So if I go out to their balance sheet, the capital, the investor supplied capital at Walmart, and I'm going to go out here to the snapshot here at October 31st, 2023. It is their third quarter end for Walmart. And if I scroll down here to the bottom part of their balance sheet, so the what we consider the right-hand side of the balance sheet, where they get their funding, we can see here, and I'm just looking up here, accounts payable, accrued expenses. That's not part of capital because that's money that that is essentially provided by the suppliers for the company, and also accrued wages, money waiting to be paid out to their employees. We have short-term borrowings. We have the current portion of long-term debt. We have the current portion of leases. These are going to be investor supplied funds then. We look down here, long-term debt. Walmart issues a lot of bonds. Long-term leases, these would be capital leases, if you're familiar with that. So we consider these kind of be interest-bearing debts. So these are investor supplied funds. Okay, so especially this $38.583 billion, that's consists primarily of bonds that investors have purchased and provided that money to Walmart. We look down here at the common stock, the additional paid in capital. That's the money, and you see it's not a whole lot of money for Walmart, but that's the money that was kind of initially invested into Walmart by its investors. And we see down here retained earnings. So these are funds that could have been possibly paid out as dividends, but haven't been. They were retained back into the company rather than paying them out. And then we have treasury stock down here, which Walmart doesn't show any. They do repurchase stock, and that's a discussion for another time. But with the way they account for that that line item is a little bit different than how other companies account for it. And so that's what we would look at as our total capital for the company, those interest-bearing liabilities, that money that has been retained into the company for reinvestment into the firm. If we continue on then, we're going to look at ROA, return on assets, and ROE, return on equity. So let me just put that in here. ROA is the return on assets, ROE is the return on equity, and we're going to look at what's called the DuPont analysis. And different textbooks or different teachers are going to look at this a little bit differently. You can break down what's called the DuPont analysis into very small, intricate details. We're not going to do that in here. We're just going to look at the kind of the big segments of this number. So ROA is equal to net profit divided by the total assets of the firm, and it tells us how well the company generates profit based on the assets that they have, the value of the assets that they have. The folks at DuPont break this down into many pieces in order to analyze the sources of that profitability relative to the assets. So we can see here that we can divide this up where it is ROA is equal to net profit margin multiplied by the total asset turnover. And we'll get into that total asset turnover when we talk about the asset management ratios. So if you look at this, net profit divided by total revenues multiplied by total revenues divided by total assets, if you cross multiply those total revenues out, you get net profit over total assets. The reason why the folks at DuPont break this out, though, is they want to see where performance is coming from. So when we look at ROE, return on equity, return on equity is a very common number that's used to analyze and to provide performance measurements for executives. And oftentimes their bonuses at the end of the year will be based on the ROE of the firm, the return on equity for the firm. And so again, the way we calculate ROE is net profit divided by total common equity. And I'll just show you here on the financial statements for Walmart what we're looking at there. So it would be, if I go out to my income statement, ROE would be calculated as the net income. So my value down here, I'll just say at the end of October was 11,680 for the last 12 months, divided by my total equity, or total common equity, sorry, of 76,693.0. So that's how we would often calculate it, or we might take the average value of equity over 2 years to calculate that number. The idea here is, though, is that, we're looking at how well managers generate profit based on the amount of equity that's been invested. Many years ago, I worked for a bank where the owner, coincidentally, was Jim Walton, the son of Sam Walton. And Jim Walton owned this bank, and he told us up front what he wanted the ROE to be. He said, I want a return on equity of 15%. And from his point of view, he was pretty much the sole owner of the bank. He owned 97% of the equity of the money that had been put into the bank. So he was, a few other managers owned a little bit here and there of the bank, but he was the owner of the bank. And he said, I want a 15% return on my money. The money I put in, I want a 15% return. Not that he was generating, 15% income off of every dollar he put in every year, but he wanted to see that in terms of net profit. And he would generally reinvest the money back into the banks. So he was telling us what our performance criteria was. Okay? And this is commonly used, as I mentioned before, as the performance criteria for a business, is that value of return on equity. So the folks at DuPont said that they wanted to see how the managers were generating this ROE. So they broke it up into many different pieces. We're going to focus on the big three pieces here. Net profit over total revenues, which is our net profit margin. Total revenues divided by total assets, which is our total asset turnover. And then finally, total assets divided by total common equity, which is the equity multiplier. So if you look at this, net profit margin, we've already talked about that a little bit. The ability to control expenses relative to revenues, the better you're at that, the better the manager is. They're shrinking the expenses relative to the revenues they're able to bring in. That increases the net profit margin. That's a good thing. Okay, in most cases, that's going to be a positive thing. Total asset turnover. Total asset turnover is the ability to generate revenues based on the assets of the firm. Again, increasing that number is generally a pretty good thing. It means that you're not investing a lot in assets to generate revenues. So you're buying the right assets to generate revenues for the firm. And then finally, the last one is the equity multiplier. This is where a company can get into trouble. If they're not doing well in the first two, but their equity multiplier is high, it means they're generating performance based on taking out a lot of debt and then using that money to purchase assets. So the equity multiplier increases when a higher percentage of the assets are being funded with liabilities rather than with equity. Also, for the period 2009 through 2022, interest rates were at an extremely low level. And so what a lot of companies did during this time was that they would go out and they would take out debt and they would repurchase their stock in the stock market during this period of time. So they were issuing debt, they were issuing bonds, they were taking the proceeds of those bonds, and they were using that for stock repurchases, to go out into the market and repurchase their stock. And so this had a direct impact on that equity multiplier. So this had a big impact on that equity multiplier because it was shrinking the total common equity directly through stock repurchases. And so we saw that ROE number really get inflated for a lot of companies over this period of time because companies were doing this. They were they were going out and they were issuing debt and repurchasing stock, and they weren't really having a big impact on the first two drivers of the ROE, the net profit margin or the total asset turnover, but really increasing this last item, this equity multiplier through stock repurchases. So why is it important to analyze the sources of ROE and ROA? So ROE and ROA are common measures used to determine whether or not managers are doing their jobs. We want to see where that performance is coming from, and that's why it's important to analyze the sources of ROE and ROA. As I mentioned before, especially with ROE, a managerial performance can look better than it is just through how the company is managing its financing sources. In other words, if they're taking on a lot of debt and they're using that to boost that equity multiplier, they can make things look better than they are. The next set of ratios are related to that DuPont analysis, and it's the financial leverage ratios. So the big one that we often look at is the debt ratio, which is total liabilities divided by total assets. The optimal debt ratio for a firm is based on the firm's assets, cash flows, and profitability. Firms can deduct interest expense for tax purposes, and so this, in many cases, will actually lower the cost of debt for companies because they get to subtract out that interest amount from their income, and so they don't pay taxes on it. Bondholders and other debt holders like banks get paid the interest payments before stockholders receive dividends and get paid off in bankruptcy before stockholders do. In other words, if a company is going through Chapter 7 bankruptcy, those debt holders are going to get paid off before the stockholders get anything. As a result, debt is considered a less expensive form of capital than equity. So think of this in kind of two ways. There's a dollar cost, and there's also a percentage cost when we think about the cost of capital. A stockholder may require for example, a 10% return on their investment. I mentioned Rob Walton before, or sorry, not Rob, Jim Walton before, and he was the equity owner of the bank I worked for, and he said he wanted a 15% return on his investment. For a publicly traded firm, that was a privately held bank, but for a publicly traded firm, that percentage is generally going to be on average lower, depending on the riskiness of the company. So you might have a stockholder that wants a 10% return, and on average the S&P 500 returns between 10 and 11% per year. So that's kind of in the range of what we would expect for a publicly traded company. The bondholder, though, will often require a lower rate of return because they're not taking on as much risk. So if I buy a bond in Walmart, for example, when I buy the bond, I know what the payments are going to be. I know, I'm going to get an interest payment every 6 months based on the coupon rate. And then at the end of the life of the bond, as long as I don't sell the bond beforehand, I'm going to get a principal, amount that's set when I buy the bond. For a stockholder, if I buy stock in Walmart, I don't know the cash flows I'm going to get. I don't know what the dividend payments are going to be in the future, although I might be able to guess. I don't know what the stock price is going to be in the future. And so I'm taking on more risk from the riskiness of the cash flows I'm going to receive. I'm also taking on more risk if the company doesn't have enough money to pay dividends. I'm not going to get any. If the company goes bankrupt, well, I'm probably not going to get anything in that case either, because the income, or the value of their assets are probably going to get paid out to other people before it comes to me. And so the cost of the capital, that percentage cost, is going to be higher for stockholders or for equity that the company takes on than for the debt that the company takes on. So as a result, debt is considered a less expensive form of capital than equity. However, adding debt to a firm's balance sheet increases the risk of the firm for stockholders and bondholders because it increases the likelihood of bankruptcy. In short, taking on more debt can be beneficial for the firm, but taking on too much debt will result in the firm not being able to grow or not being able to cover its debts and not survive. So what I want you to take from that kind of the discussion there, is that oftentimes when we talk about debt, people have the idea that firms taking on debt is a negative thing, it's a bad thing, when in fact it can be a good thing for the firm because they're lowering the returns they have to generate on their projects. They're lowering the cost of doing business essentially in terms of providing a percentage return. However, taking on too much debt can be harmful for the firm. The next item we have here is the long-term debt to equity ratio. The long-term debt to equity ratio is used as a measure of the amount of interest-bearing long-term debt, a long-term financing source, relative to the book value of equity for the firm. Now notice up here we have total liabilities, and that's going to include non-interest-bearing forms of debt as well. But down here there are short-term forms of interest-bearing debt, but most of that interest-bearing debt for most firms is going to be long-term debt. And so this kind of concentrates on that interest-bearing portion. Book equity by its nature is a long-term financing source because it's provided by the equity investors, and it stays there until they pay off those equity investors. If the firm is using equal amounts of debt and equity for its long-term financing needs, the ratio is equal to 1. It is different than the debt ratio primarily because it doesn't include all liabilities, as I mentioned before. For example, a retail firm may have a high debt ratio but a low long-term debt to equity ratio if the firm has a lot of accounts payable but little long-term debt. Like the debt ratio, this is another measure of solvency, the ability to not go bankrupt for the firm. Some firms can safely take on more debt than others, and just like the debt ratio, for many firms some long-term debt can be beneficial, but too much results in the ability to make required payments. Another measure that we often look at is the times interest earned ratio. This is different than the previous two because the previous two looked at the amount of debt the firm had relative to the assets and then the equity of the firm. The times interest earned ratio looks at the ability of the firm to service that debt. So what we have here is the EBIT, earnings before interest and taxes, divided by interest expense. So how much, this looks at how much interest the company can generate, or excuse me, earnings the company can generate, and how many times that covers the interest expense of the firm. So the times interest earned ratio, also known as the times TIE, is a measure of the ability of the firm to cover its required interest payments with its operating earnings. EBIT stands for earnings before interest and taxes. This is often presented as operating income. The higher the TIE, the greater the ability of the firm to make its required debt payments. Note that TIE assumes that firms primarily use bonds as its method of raising funds using debt. The reason I say this is that other forms of debt require principal payments. I'm going to mention one of these here in a minute, but if the company is just issuing bonds as their form of long-term debt, they're just making interest payments on those bonds until the maturity date. So, when we think of a bond, a company takes out a bond and they make interest payments usually every 6 months, and then at the time of maturity they pay off that principal value. In many cases, a company will just issue another bond to pay that principal value off and continue on making interest payments over time. The lower the TIE, the lower the ability of the firm to cover its debts. However, higher isn't always better for stockholders. As indicated with the other two ratios, some debt can be beneficial for the firm and for stockholders, and we'll discuss this in another video later on. I want to mention one last ratio. It's often not included in textbooks when we talk about ratio analysis, but having worked at a bank and talked to a lot of regulators, this is a common ratio, especially for smaller firms. That's very important, and it's called the debt service coverage ratio. Debt service coverage ratio. So I'll go ahead and include this one here. And I like to include this one because if you go into finance and you're working either as a lender or within a business and you're in a smaller business, you're probably going to come across this ratio. The debt service coverage ratio is equal to EBITDA divided by the required interest and principal payments. And I mentioned with the times interest earned ratio that we're making the assumption when we look at that ratio that the company generally finances with bonds where they're only making interest payments. But when you're looking at smaller companies, companies that can't just go to the bond market and issue new bonds, they're oftentimes taking out loans from banks that are going to require both interest and principal payments on a monthly basis. And so it's important to recognize that those principal payments are required. And so we include that in our calculation here. And I mentioned earlier on in this set of notes that the numbers themselves oftentimes aren't terribly useful. We look at a trend over time, and we look at the numbers compared to other firms in the same industry or as the industry as a whole. This is one of those where there is an important number. When we look at the debt service coverage ratio, so the operating cash the operating cash flows of the firm, EBITDA, divided by required interest and principal. Sorry, let me put a word in here. Payments. What regulators like to see here in the United States is a minimum of 1.25. So they want to see that the company has the ability to pay their required interest and principal payments 1.25 times based on the cash flows generated from operations for the firm. Higher is usually better for this number from the point of view of the lender, from the point of view of the regulators and the banks, in this case the lender. However, too high means that they may not be taking on an optimal amount of debt from a point of view of a stockholder. So let's move on now. So that kind of covers the leverage ratios. We're going to move on now to the asset management ratios. So turnover ratios are the first type of asset management ratios we're going to look at. And these measure the productivity or the efficiency of business assets. In other words, whenever a manager buys or invests in an asset for a firm, we want to make sure that that asset is one that will actually generate sales and generate profits and generate cash flows. All too often, we think that as a firm gathers up assets, it becomes more valuable. And that's actually not the case, because from an investor's point of view, I don't want the company to have a lot of extra assets that aren't being used to generate cash flows, because they're just extra things that they don't need. And so we want to make sure that the investments that the firms are making, the assets that they're carrying, are actually generating returns for investors. So the first two ratios here are the receivables turnover ratio and the inventory turnover ratio. We calculate the first one as total revenues divided by the average accounts receivable. This first number tells us how many times per year the company collects its receivables. So accounts receivable for a firm represent money owed to the firm from the customers of the firm. Let's look out here at Walmart. We're going to see that they actually don't carry a lot of receivables, because if you're familiar with Walmart, if you go into Walmart and you buy something, they're not issuing you credit. So even if you pay with a credit card, Walmart's getting their money right then. They're not waiting for 30 days to collect it. But when we have companies that sell business to business, oftentimes those companies will issue credit to the company that they're selling their product to. So I mentioned Walmart out here. We can see their accounts receivable. You can see it, total receivables here. As of October 31st, 2023, we're just 8,625 compared to revenues of 611,289, or actually not even that. Sorry, 638,785. So they have a very small amount of accounts receivable relative to the revenues. It's tiny compared to the amount of revenues that they have. Because in their in their businesses, they generally don't issue receivables. So their receivables turnover is going to be very high because they collect that amount of receivable, their receivables many times per year. Higher is usually better for this number because we don't like to see companies with a lot of receivables just sitting out there. And so that they're collecting those receivables very quickly. We're going to actually look at a better number later on for this. Inventory turnover. This tells us how many times per year on average This tells us how many times per year the company sells through its inventory. In other words, how fast is it selling its inventory? And again, higher is usually better because it means they're turning over their inventory faster. Fixed asset, and so you might notice here it's the cost of goods sold divided by average inventory. And up here I say average accounts receivable. So the way that Capital IQ calculates it, and the way that a lot of accounting textbooks will have this, would be the beginning inventory, so the previous year's value of inventory in the case of inventory turnover, plus this year, the most recent year end, divided by 2. And the same thing up here with accounts receivable. Fixed asset turnover. This tells us how well the company generates revenues based on the value of its net fixed assets. So at the beginning of this portion of the notes, I mentioned it's important that the company is investing in the right assets. So if a company just randomly buys buildings and buys lands and buys equipment and just buys stuff without thinking about how well that asset is going to generate revenue, they're going to buy a lot of stuff they don't need. They're going to be investing in assets that aren't generating returns for their investors. And so this is an important number to look at because it tells us how well they're making those decisions in finding the right fixed assets to invest in for generating revenues for the company. Higher is usually better. And then finally, total asset turnover is related to the fixed asset turnover ratio, because instead of just looking at the fixed assets of the firm, the equipment, the buildings, the land, it's looking at all of the assets of the firm, including things like accounts receivable and inventory and those items as well. And again, higher is usually better. You can have an odd situation where an increasing value for fixed asset turnover and total asset turnover can actually be a negative thing for a business. So for example, a few years ago, when Sears was facing its demise and going downhill pretty quickly, the fixed asset turnover ratio for that company was actually going up. So if you don't recall, Sears owned both Sears and Kmart. And they actually owned a lot of other businesses too. If you're familiar with Land's End, a clothing company, if you're familiar with Craftsman, if you're familiar with any of those brands, those were all owned by Sears. And so what was happening in its waning years was that Sears was selling off its assets and chunks of its business, like Land's End, like the Craftsman line, like the Kenmore line, very quickly in order to generate cash, because they were running out of cash. And so what was happening was that fixed asset turnover ratio was actually increasing, not because the company was doing better or making better investments, but they were actually selling off assets faster than sales were dropping. So the sales were decreasing over time, but the value of their assets on their books was increasing even faster because they were selling off so much so fast that this ratio was actually increasing while the company was seeing the end of its life. But in most cases, an increasing value taken into consideration with other different ratios is a good thing for fixed asset turnover ratio and total asset turnover ratio, because it means that management is buying the right assets to generate revenues. The last item I have here in the turnover ratios is one that's not an actual asset turnover ratio, but I like to include it here because we're going to talk about the cash conversion cycle here in a few minutes. And this is one we need to recognize for that. It's the payables turnover. You notice here I have a little footnote here. I'll explain it here in a minute. But payable turnover tells us how well we generate, how fast we're paying. The company is paying its on its payables. So pays off its accounts payable. And really what we're looking at here is how fast that they get paid. So a high number here really isn't necessarily a good thing, because it means you're paying your accounts payable really fast when you might not need to, when the company might not need to. And so I don't really want to say lower is better here, but a little bit lower can be a good thing for a business, because they're using other people's money for a while to finance their inventories in most cases. I'm going to move on now for some of these and calculate the days calculations. And so specifically we're looking at the receivables turnover, inventory turnover, and payable turnover. We're changing this around though. Instead of calculating how many times per year these get paid off or we sell our inventory, we're actually looking at how many days it actually takes for the company to collect on its receivables, to sell its inventory, and to pay on its payables. And that's what we're looking at here. AR, days sales outstanding, or sometimes you'll just see this as DSO, or days sales outstanding. This is the average accounts payable, or excuse me, receivable. So this is going to be calculated as the receivables at the beginning of the year, the receivables at the end of the year, divided by the average daily revenues, which is the total revenues divided by 365. Shorter is generally seen as better here. This means that the firm is collecting its receivables, its accounts receivable, faster. So I'm going to pull up Walmart here. They're going to look a little weird here, but they do have a number for this, so we're going to take a look at that. So I'm going out here on Capital IQ. I'm looking up the ratios for the firm. And I'm going to scroll down here to the short-term liquidity. And so you can see here it's got average days sales outstanding. So this is average. I mentioned accounts receivable days sales outstanding. That's what this is. It's really low for Walmart, again, because they don't sell things on credit. They don't have a lot of accounts receivable. But we can see here, it takes them on average around 4 to 5 days, if we're calculating this. Because they have so few receivables outstanding, this number is very low for them. Okay. The next one, and I'll just go switch back and forth between the notes here. Days inventory outstanding. This is more meaningful for Walmart because this is actually pretty important for a company like Walmart. They don't want inventory sitting out there too long. If you think of the grocery side of Walmart, a lot of those groceries are perishable. They have best by dates. So they don't want those things sitting on their shelves too long. If inventory is sitting on their shelves too long, that means either they bought the wrong inventory, and so people don't want it and they're not buying it, or their marketing is not good, or their pricing is not good. But they don't want, it's a bad sign whenever a company has inventory that's sitting out there for too long. So this tells us how long it takes for a company to sell its inventory on average. Shorter is usually better. And again, I'm saying the term usually because you can actually sell your inventory too fast. If you're selling your inventory through too fast, it means you probably have a price too low. You probably need to increase those prices. But in general, we like to see inventory sold quickly, especially compared to the industry. If you're taking longer than everyone else to sell your inventory, you probably have the wrong inventory or something else is going wrong there. So taking a look at Walmart here, again, this is an important number for them. We can see that it's actually increasing a little bit. And as a manager at Walmart, I would be asking why. But their average days inventory outstanding, 41.7 days, 41 days, 38.9. This was actually likely due to COVID. And, while for some companies that number may increase because people weren't buying as much, people were staying at home and probably the inventory that they were selling a lot of at this time were probably more groceries and fewer other things. So they may have been selling through their groceries much faster. People aren't eating out as much, so they're buying more groceries, things like that. And then we see it actually creep up a little bit over the past couple years post-COVID. So shorter is usually better. It means that they're selling through their things faster. They're getting things off the shelf faster. Finally, days payable outstanding. Days payable outstanding, that's going to be your accounts payable. So that's the money that the company owes their suppliers. This tells us how long it takes on average for the firm to make or to pay their accounts payable. For the other ones, we usually say shorter is better. As I mentioned before, for accounts payable, longer isn't necessarily better, but too short and you're not taking advantage of the credit that's being offered by your suppliers. Too long, and those suppliers are going to get worried that you're not going to pay them. So longer is usually better, but too long is not good. Okay. We take these three numbers and we calculate then what's called a cash conversion cycle. For a lot of companies, this is an important measure because it tells us how long it takes the company to start with cash, invest in inventory, sell that inventory, get their cash back from their customers that if they've issued accounts receivable to them, and then it takes out the amount of time that the company uses to pay their suppliers. And so it tells us how long, essentially we go from cash to cash. Okay? We complete that cash conversion cycle. A shorter cash conversion cycle is generally seen as better. A shorter cash conversion cycle generally means that the firm does not have to rely as much on external financing for its operations. So again, let's take a look at Walmart here. Walmart's going to be an odd duck a little bit because they don't issue credit whenever they sell things. So we can take a look at here. Their cash conversion cycle is actually very short. Their payables days are generally really close to their inventory, their days of inventory outstanding. So we see here, and I'm just going to use the example of 2022, January, for the 12 months ending January 31st, 2022. The days it took them on average to sell their inventory was 43.2 days. The days they paid, they took to pay on their inventory was the same amount of days, 43.2 days. And so they're not needing to borrow money to buy their inventory because they're putting that inventory on the shelf, and it's taking them the same amount of time they're taking to pay. So essentially they sell the item, they turn around, and then they pay the supplier for that item once it's sold. They're not needing to borrow money or use their own money really to pay for that inventory before it's sold. And we can see their cash conversion cycle as a result is very short in each year. So it's 1.9 days here, 1.9 days, 1.3 days, 4.6 days, 6.5, and then 8.6 days, which are very short times for the cash conversion cycle. The last set of ratios we're going to talk about in this video are the liquidity ratios. So liquidity ratios provide information on how well the firm can cover its current obligations with its liquid assets. So when we think about liquid assets, these are assets that are either cash or can be converted to cash quickly. So why is it important for firms to have sufficient liquid assets to cover current obligations? And this is a question I get sometimes. Why can't they just cover the current obligations with sales and profits? Well, you have to have something to convert to sales, and that's really the issue here. If I'm thinking about a balance sheet for a firm, a lot of those current liabilities are going to be the inventory that are going to be debts that the company owes for its current assets. So let me just pull up Walmart again here. If we look at the balance sheet, I'll go out here to the balance sheet for the firm. So the balance sheet here, we have the major, items on the balance sheet. They've got some accounts receivable, but as we mentioned before, that's not very big for Walmart. Their major sources, their major assets out here. And again, I'm going to look at October 31st, 2023. Inventory is the big one, okay? $63.9 billion worth of inventory out there. When we look at their liabilities, their accounts payable is their largest form of liability, $61.05 billion in accounts payable. And accrued expenses are $22.8 billion. And those are going to be largely consisting of accrued wages. So whenever they have an employee that comes in and they clock in, that creates a liability on the balance sheet for Walmart because they have to pay that employee then. So the idea behind liquidity and liquidity ratios is that the company has to have assets on this side of the balance sheet to convert to cash to pay for these liabilities. Okay, so they have accounts payable, they owe their suppliers, they've got to sell these current assets, generate profits, generate cash flow, more importantly, to then pay their suppliers off and then also to pay their employees. And so that's why it's important that the company have those liquid assets in place. And again, just to answer this question, why is it important for firms to have sufficient liquid assets to cover current liabilities? Because those liquid assets are converted to cash to pay those liabilities. So what is liquidity? Liquidity kind of has two dimensions. Speed and value. A liquid asset is an asset that can be converted quickly to cash at or near its market value. So, for example, houses are generally not very liquid assets. Unless you're in a market where the housing market's really hot, it's going to take a little bit of time to sell your house at its market value. You can sell a house very fast, but not get very much money for it. So if I went out today and I put my house up for sale for $15, okay, I'm gonna sell it really, really fast, but it's nowhere near the value of the house. If I price the house at its value, it's going to take a little time usually to get it sold because you have to find the right person to buy that house that wants that house in that neighborhood and house with this right number of bedrooms and bathrooms and garage spaces. And so it takes a little bit of time. So a house is generally not a very liquid asset. A can of soup at Walmart, that's a much more liquid asset because, it's going to get sold pretty fast as long as it's the right type of soup. It's what people want, it's at the right price, then people are going to come in and buy that piece of inventory. So we generally think of, inventories as liquid assets, but we're going to talk a little bit about that. We generally think of accounts receivable as fairly liquid assets. And as long as the customer that accounts receivable was issued to has good credit and is paying on time, those are actually fairly liquid assets. Companies can sell their accounts receivable at near their value pretty quickly through what's called factoring. A lot of companies don't do it, but it is certainly a way to convert receivables to cash at near their value, total value, pretty fast. So we have two different ratios here that we look at for liquidity generally. The current ratio, which is current assets divided by current liabilities, and the quick ratio, which is current assets minus inventory, and I'm going to explain this, divided by current liabilities. So current assets, when we think of current assets, we're generally thinking about accounts receivable cash, accounts receivable, and inventory. Okay. When you think of taking you back to the balance sheet, current assets are assets that are expected to be converted to cash within the next 12 months. Current liabilities are liabilities that are expected to be paid or are due within the next 12 months. And so what we're looking at here is we're looking at the amount of the assets that are expected to be converted to cash within the next 12 months divided by the amount of liabilities that are due within the next 12 months. And so generally we want to see, enough current assets that can be converted to cash to cover those liabilities. A common misconception is that a higher value here is a good value. In fact, it's not. A really high value here means the company is carrying a lot of assets that aren't generating much return. So if we think about those, a company just holding on to a lot of cash, or if they've got a lot of accounts receivable in the book or a lot of inventory, that's usually not a good sign. If they have a lot of accounts receivable sitting out there on their books, it means they're not collecting them fast enough. If they've got a lot of inventory sitting out there, it means they're not converting it to cash fast enough. They're not selling it fast enough. So we generally don't like to see this one be too high, at least from a stockholder perspective. So stockholders generally don't like very high current ratios or quick ratios. We're going to talk about that in a minute, because current assets earn little, if any, return. Okay? In fact, it can cost the company. If a company sits out there with a lot of inventory, they're paying to insure that inventory, they're paying to hold that inventory, and so selling through it is not keeping a lot on the books is a good idea. But we do want to see that there's enough out there to be converted to cash to pay off those liabilities. Quick ratio. So it looks a lot like the current ratio, except for we subtract out inventory. And the reason why we subtract out inventory is the book value of that inventory, especially in liquidation, is questionable. Oh, let me actually put it in the right area here. So I put down below, why do we take out inventory out of the current assets? For the quick ratio, inventory is taken out because the book value of inventory is questionable, especially in liquidation. So if we're looking at a company that's not doing very well, that the value of that inventory may not be what we can get for it. Especially if we're looking at a company like a manufacturer where some of that inventory is going to be work in progress. So you think of a car manufacturer that's building cars. Well, the value of some of that inventory you see on the books is just going to be half-built cars that you can't do a whole lot with if you had to sell it off quickly. I've unfortunately been in a situation where I've liquidated as a lender a couple of different companies, and the money you get for inventory is questionable. In one case, we had to foreclose on a used car lot. We showed up one night to take the cars, and it was this big dramatic scene where there's several loan officers there. We were basically called to help out to move all these cars. And, the sheriff shows up because the lot owner wants us arrested for trespassing, and it was this big ordeal. And then finally, the sheriff says, no, they can take the cars. You're not making your loan payments. And we go out, we get all the keys, and we get in the cars to start them up, and they don't start. The cars actually didn't run. And so we had to jump start the cars. They'd been sitting out there for too long, and nobody had started them. But it's hard to get the money back out of those cars because they're not running well. They weren't actually running the night that we had to take them. So that's just one case. I had a couple others there. But what I've generally found, and what's generally true, is that getting the money out of inventory in a liquidation situation where you have to sell off the assets of the firm, a lot of that value just isn't there. So the book value of inventory is questionable. We can usually divide up inventory into three different categories: raw materials, work in progress or work in process, or finished goods. So when we think of a company like Walmart, all of the stuff they sell is finished goods. They buy them. You're not manufacturing goods there in Walmart. Their workers aren't creating new products from raw materials. So Walmart's going to be all finished goods. Usually, though, when we've got a manufacturer, the raw materials, the value on the books of that inventory on the books is actually closest to the value you're going to get. Finished goods is in second place. And I mentioned that the raw materials generally has the closest value to liquidation value is because oftentimes you can take those raw materials and sell them back to the supplier as long as they have another outlet for those materials, or you can sell them to another producer, another manufacturer, to close to the value that you paid for them. Finished goods, especially if a company is going out of business, it means they haven't been able to sell their finished goods very well. And then finally, works in progress. Oftentimes these don't have any value. You can't really sell a half-finished car or a half-finished piece of equipment or furniture. And so sometimes you just have to dispose of these items. And what I'm comparing this to, where I say generally has this second closest value, we're looking at the book values of these items. So the book value of raw materials is usually closest to the actual value we would get in liquidation. The finished goods is the value of that on the books is generally second closest to the liquidation value, what we'd get in liquidation. And then a work in progress, again, usually doesn't have a whole lot of value for the lender if you're in a liquidation situation. So that's why we use the quick ratio, is we're really looking at if we had to quickly liquidate the firm and get our cash out, what would that look like? And oftentimes the inventory value just isn't there. So that's where we're going to stop this first video on financial ratio analysis, and then we'll start with using financial ratios in financial models in the second lecture.